In this lecture we are going to be looking at a market manipulation example that occurred in the British pound versus the Japanese yen in the 1-hour timeframe. This can be considered an intermediate level trade because the analysis cannot be categorized as simple, but it's far from being the most difficult trading scenario. There are many things to unpack in this chart, so without further ado, let's begin the analysis right away. As usual, I marked what I consider the major extremes of the market with numbers to facilitate the visualization of the deeper and less obvious details we are going to be looking. The first interesting thing in this chart happens between numbers 1 and 2. It should be clear to you the difference between the strength of both major and minor flows in a situation like this. Numbers 1 and 2 clearly point to extremes in the major dimension. I marked out zigzagging lines in blue to point out the minor flow happening constrained between numbers 1 and 2. This is an almost textbook perfect and real-life example of the minor flow happening inside the major flow. The other important detail about this market vector between numbers 1 and 2 is the fact that price clearly and undeniably surpassed the high number 0. This is a green light for us to call the low number 1 a major and confirmed market structure. The reason for that is logically consistent. When price breaks the high number 0, the information that we can infer is that buyers are strong enough to create higher highs, and the last absolute origin of the most recent and most relevant movement is the low number 1. This is why we can call it a confirmed market structure, and this is also why we can use such levels to place stop-loss orders. They act as a protection. In the market vector between numbers 2 and 3, the market goes back down after the buyers from number 1 exhausted themselves. This is another important thing to understand. Buyers and sellers alternate at all times regardless of the trend bias we have because while one is exhausting its energy, the other is recuperating it. That's why we can have significant counter-trend movements. Observe that in number 3, price comes down near number 1 roughly speaking, and it does that creating a candle with a significant lower tail. That means the buyers that were previously near the low number 1 stepped up a little bit, and they are now willing to bring the market up in a higher low. Once again, this is almost a textbook perfect representation of uptrend. Notice that after number 3, the market goes sideways for a few candles. When the market goes sideways like that, we can safely say that both buyers and sellers are in a state of relative equilibrium. Buyers are not so sure if sellers are completely exhausted yet, and sellers are probably assuming the same about buyers. The most obvious clue we can derive from this portion of price is the conjunction of weird lower tails that happened after candle number 3. Another interesting thing about a sideways market is that it usually happens when the energy of one of the market players is exhausted too quickly, which is exactly what happened in candle number 3. Instead of coming down in a relatively calm manner, price dropped rather violently, and that disrupts the natural flow of how price behaves. This rupture must be corrected somehow. That's why we see that sideways movement after number 3 as a compensation. In number 3.1 we begin to see the first signs of a real market manipulation. So far we have been only describing the market in what appeared to be its natural flowing state without the intervention of large traders or anything like that. Candle number 3.1 marks the precise moment where buyers took control of the market again and decided to raise it dramatically, but there is an important detail here. As it is usual in moments that precede price manipulations, we can see price rising in an orderly fashion. Here we have to be clear about what we mean by that. Price usually behaves in an apparently chaotic motion, and individual candlestick highs and lows seem to be disconnected most of the time. If we look inside the red box in number 3.1, we are going to see that price rises creating a higher high and a higher low with each closed candle. The reason that happens is that large traders intervene at the open of every candle to ensure a continuous flow to their desired direction. As we already saw in other examples, a solid movement like that grabs the attention of many retail traders in the market. We can say that this is the first moment in which the von Restorff effect takes place. Let's be more precise about what that means in this moment and what that might mean in the immediate future. When retail traders see a movement like that, they begin to assume that buyers are really strong, and that a long position is an almost certain way of making some money in this market. This assumption is not exactly wrong, but it is incomplete. What retail traders fail to understand is that the forces producing this exaggerated movement to the upside are not necessarily an irrational combination of many traders going in the same direction. It's probably a result of market intervention, which is something that should make retail traders more skeptical instead of more certain about where price might be going. However, there is a sinister element to this first leg up in the market because its function is not to manipulate traders right away. Its purpose is to add a little more complexity to the second time where the von Restorff effect will appear later in the chart. If you pay close attention, you will see that in the leg between 3.1 and 4 we have the von Restorff effect and the bandwagon effect, but the reverse psychology element is missing because the market is not breaking any levels that could produce some sort of confusion. In other words, this first leg is not a manipulation. It's just an intervention that goes in the direction of the main trend, and it will serve to confuse traders in a different way in the near future. After candle number 4, price starts to fall down just like a rocket that has lost its upward momentum. Notice how it shoots up after 3.1 and it starts to fall down really hard after number 4. Now we are talking about the moments where the real manipulation really begins. Just like the orderly behavior marked inside the red box, the movement after number 4 shows the same quality. Once again, this grabs the attention of retail traders. However, there is an important catch here. Because of the illusion of certainty created by the movement after 3.1, retail traders are now confused when the market starts to come down hard like that. After all, it can be difficult to tell which of the market players is indeed the strongest if they have the same apparent strength, roughly speaking. The fact is that the market is filled with people that see the market vector after 4 with a static bias. Assuming that we have large traders producing the movement down after candle 4, they are probably intending to trigger the breakout traders that are looking to sell this market in the level that I marked as the last solid structure, which is the absolute low that represents the point of ignition of the main buyers of this market. The orderly behavior after number 3.1 should serve as a point of clarification for those who understand the market maker mentality. The reason for that is not so obvious, but it makes sense under the light of what we are seeing here. If the large traders after number 4 are looking to trigger the breakout traders who want to go short, the natural conclusion is that these large traders want to go long. This perfectly matches what happened after number 3.1, which was just an intervention and not a full-blown market manipulation. In other words, the large traders of this market seem to have a predominantly upward bias, so it becomes almost comical when you are capable of understanding that and you see a ridiculously volatile movement like the one after candle 4. It's almost too obvious that these large traders are going to hurt somebody in the market. Once again, this is powerful knowledge, and this is also the time to step back and observe the market. In number 5 we can see price breaking the last solid structure line, and therefore triggering a huge amount of retail breakout traders who thought that was a good level to go short. The market vector between 4 and 5 is clearly the von Restorff effect portion of this manipulation. Pay close attention to the shape of candlestick number 5. It pierces the line where retail traders placed their sell stop orders and it ended up closing above it. This is the reverse psychology portion of the manipulation taking place, meaning that large traders successfully induced retail traders to the downside, but with the goal of actually driving the market to the upside. This is probably the trickiest part of any manipulation. There are two key elements to understand the reverse psychology that goes on in these subtle market maneuvers. The first is that large traders need retail traders to create deep liquidity pools. The second is that to create these deep liquidity pools, first the large traders must induce retail traders to one side, but they actually want the market to go in the opposite direction. This contrary movement is a practical necessity for the creation of the deep liquidity pools by hitting the cluster of orders placed by retail breakout traders. As we already saw in previous lectures, the bandwagon effect is the missing piece that finishes the manipulation. When candle number 5 does not meet the expectations of breakout retail traders, they become confused and usually pretty desperate because they use very tight and arbitrary stop-loss orders. A sideways market in a situation like this is exactly what these traders don't want, and that's exactly what they experience. The smart trader should be still observing the market at this point and looking for hints that might create a trade opportunity. One of these hints is where the candle 5 tail landed, which is the line marked as the second last solid structure, which points not to the absolute structure point, but to the rough point of ignition of the last confirmed market structure in number 1. The idea for a trade comes in number 6 when we have a candle with a large lower tail touch this line once again. Under the light of the market maker strategy, this is an opportunity for a few different reasons. We are in the moments that precede the bandwagon effect of this manipulation, meaning that if we are correct in our reading of the large trader dynamics, price is about to go up by the massive order dumping of the large traders and also by the desperate retail traders looking to recuperate their most recent losses. The other element to this trade is that we can use low number 5 as an axis in conjunction with the structure number 1. The expressive lower tails of these candles are also very important because they subjectively tell us there is buyer pressure in the market. The trade you see opened in the chart was triggered right after candle 6 closed. The stop was placed below lows number 5 and 6, and the target is naturally 3 times as large as the stop to give us a nice 1 to 3 risk-reward ratio in this trade. One interesting thing about candle 6 is that under the light of the fractal flow strategy, which is another way of looking at the market, we would be able to characterize it as a fractal candle, and we would have a more objective way of telling that this is indeed a sign to trigger a trade. Let's see how the market behaves next. As you can see here, the target was successfully hit, showing that our reading of the large traders dynamic was indeed correct.